For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
Investing in shares today can be your gateway to financial freedom. To participate in the stock market, you need to open a CDS and a trading account. Here's a quick guide to help you open these accounts. A CDS account. CDS or Central Depository System account is fully owned and operated by Bursa Malaysia Depository. It keeps a record of the ownership and movement of shares traded on Bursa Malaysia. Simply put, when you buy stocks, shares are credited to your CDS account, and when you sell stocks, they are debited from your CDS account. In addition to a CDS account, you also need to open a trading account with a broker. A trading account is used to place your buy or sell orders in the stock market. Let us show you how to open a CDS account and a trading account in 3 simple steps. Step 1. Access Bursa Malaysia website and choose from any of the licensed stockbrokers listed on the website to open an account. Step 2. Once you have identified your preferred stockbroker, bring along your identity card and your bank documents to the stockbroker's office for verification. Step 3. Look out for a confirmation notice from Bursa Malaysia in your mailbox in the next few days. This mail will provide you with all your account details which you will use every time you trade. If you are new to the market and would like to learn the fundamentals of stock investing, please visit www.bursamarketplace.com. That's it! With these 3 easy steps, you are ready to start investing in the stock market and move towards achieving your financial freedom. Open your CDS account and trading account today. Happy investing!
Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. So today we are also very excited to be doing this portfolio management topic. This is a very advanced portfolio management topic that is titled Engineer Your Portfolio Performance by Allocations Optimization. Okay, by reading the title alone, I think it has already impressed us with the kind of depth that our speaker is going to share today. And yes, he is none other than David Poh. Okay, so are you guys ready for David? If yes, right, please type ready. Okay, and let me know. Wow, ready to rumble. Okay, thank you so much. So as usual, disclaimer. So whatever we share on this webinar is only for educational purpose. So in no way that we give any recommendation to buy or sell any companies. So if you decide to make any investment decision after today's webinar, you do it at your own risk. So allow me to briefly introduce our speaker today, and he is David Paul, the founder of Spiral Thinker Group, Sdn Bhd. So an engineer by training, David began his career as an engineer in the telecommunications industry for 10 years before turning to his passion in value investing. So he is the founder of Spiral Thinker Group, and he's now a full-time investor and dedicate his time and resources to nurture the youth in financial literacy. So he's often invited to speak in brokers' webinars, seminars, as well as other Bursa endorsed events, and his professional comments and opinions on value investing are often featured in business publications like Focus Malaysia. So David also provides consultation services in value investing and advanced portfolio strategies for high net worth individuals. So this is a brief profile for David. So David, how are you today?
Hi, good evening, Shane.
Yes.
Feeling good. Today it's a bit cooling because of the rain.
Yeah.
Your Wang Ye is here already. So I hope everyone is doing fine as well. Yeah, cool. Okay. So Shane, I take over the slides, yeah?
Yes, no problem. All right.
Okay, give me a second. Right, can you guys see my slides?
Yes, perfect.
Yeah, cool. Once again, thanks to Shane, LifeChamp, as well as Bursa Malaysia for inviting me, as well as Spiral Thinker, yet again, to a session by Bursa Malaysia, the educational series. Yeah, tonight will be my last session on this platform, because as you know, this Spiral Thinker Gamma is our education unit. So for the fourth quarter, we'll be busy with a special workshop for our members as well as students who want to pay for this workshop on electric vehicle. That's why tonight will be our final Bursa session on LifeChamp as well as Bursa webinar. Yeah, but fear not. I promised Shane already, this is going to be a bombastic topic called engineering your portfolio performance by allocation optimization. Yeah, I think it is quite timely as well for at least myself or my team to wrap up this year's topics, at least as far as we are concerned. To talk about, to maybe gear our discussion more towards portfolio management, yeah, because we talk a lot about, industry sectors, ESG, revisiting electronics, I think a couple months ago. So I think it's a good time for us to bring together what we've learned so far, because like it or not, a lot of those are industry picks or stock picks, all right, or more focused on the companies, but this one is more focused on your portfolio. And a lot of you are wondering, hey, how do I, make sure that whatever profits that I made before are protected from, if there's another market drawdown, or what if my portfolio is not doing so well now? What can I do about it? Yeah. So that is the gist of tonight's session. Yeah. Like as usual, I'm going to split my session to 4 topics. So we're going to start by talking about how to measure your portfolio performance. Then, of course, in order to measure, you need to benchmark with something, right? So the second topic will be on benchmarking. The third one will be on allocation strategies. Now, I cannot stress enough, if you have been with me, or if you listen to my sessions about portfolio management before, right, you understand that I cannot stress enough the importance of allocation strategy. So tonight we're going to revisit this topic again for the home run, yeah. And last but not least, I'm going to share a couple of case studies on what happened in real portfolios and what we have done, to revive the portfolio performance. Okay. Now, without much further ado, this will be the first topic: measuring portfolio performance. Now, I'm going to bring out an old slide that I've done many years before. In fact, now thinking about it, 2018, right? So that's about almost 3 years ago, right? December 2018, where I for the first time on the Bursa platform, where I talk about portfolio management. Now, this is a very, I would say, timely quote by Lord Kelvin. If you know Kelvin, it is the other unit measurement unit of temperature. So he said that if you cannot measure anything or you can't measure it right, you simply cannot improve it. And I stand by this. It is so important, especially when it comes to portfolio. All right. So don't worry. You may think, hey, I've got not much money in my portfolio, right? In fact, that is I would say, a myth that I want to bust here. As long as you have more than 1 or 2 stocks in your portfolio, in your holding, right, you need to know how to manage your portfolio already. The size doesn't really matter, but as it grows, as your capital grows or your investment capital grow, then it is the importance of managing your portfolio becomes even more crucial. Okay. Now, so I'm going to introduce the common methods of how people measure portfolio performance in the market, namely the Trainer's measure, Sharpe's ratio, and Jensen's alpha. Now, I'm sure that among, I think tonight, how many do we have? I think more than 300, close to 400. I'm sure that a lot of the participants may have heard about this. So tonight, my objective is not to go through in detail about these, but simply to introduce to you what are commonly used. And then I'm going to share with you guys how we do it on our own in an even more practical manner. Yeah. So these are the 3 gentlemen for the measurement techniques that I shared, that I presented earlier. This is Jack Lawrence Trainer. He's an American economist. He is a founding father of CAPM. Now, if you are a finance or economic student or graduate, right, you know what CAPM, CAPM is actually the capital asset pricing model, a model which is widely used, in financial modeling, right? But it has a lot of flaws. Okay. Now, second one is this William F. Sharpe. He is a Nobel Prize winner back in the 1990s, as well as Michael C. Jensen. Sorry, Emma, there's a spelling mistake here. He's an American economist. Okay. Now, I'm going to show you the formula first. Don't worry. Don't worry. As you know, I like to show formulas, but don't be intimidated by it. Okay. The formula is actually very, very simple. This is the Trainer measure, which is denoted by portfolio return. Take away your risk-free rate, divide and the holding divided by your market beta. Okay, then Sharpe ratio is the portfolio return minus the risk-free rate divided by standard deviation of the I think it's the portfolio, as well as Jensen's alpha, which is the portfolio return minus by the CAPM. All right. Now, there is something that is common among these. Among these formula here, which is actually, as you can see, between the Trainer measure as well as the Jensen's alpha, we've got this thing called the beta. Now, what is beta? In investment, in the world of investment, beta basically shows you how close is your stock or your portfolio tracking the general market. For example, if the beta equals to 1, it means that your market is very closely, your portfolio or the stock that you're invested in is very closely correlated to the market movement. Okay, so if the market moves out 10%, likely your portfolio or your securities will also move in tandem with the same magnitude. On the other hand, if it is a -1, it is the total opposite. Yeah, if the market moves up 10%, then your portfolio or your underlying security will go down by 10%. Okay, so that's the general definition or very layman's way of what is market beta. Now, the other thing is the standard deviation, or what we call ST. Standard deviation basically means how far, right, is your incidental data point of either your price of your stock or the portfolio value against something like an average line, okay, something like a moving average. Okay, so the further the data point is away from the average, then the standard deviation will be higher, and vice versa. Okay, so the reason why I explained the basic definition for between this beta and standard deviation, because we will be talking a little bit about this in detail in the next couple of slides. Okay, now don't worry if you can't really grasp it. I'll give you some examples later. All right, so let's put these formula into some hypothetical examples. Now let's look at the trainer's measure first on the left, denoted in blue color, right? So again, trainer's measure is denoted by portfolio return minus its risk-free rate, and then the result you divided by beta. Okay, now assuming the 10-year annual KLCI return, so assume that in the past 10 years, the average annual return, which if you invested in a KLCI index, right, you'll be getting about 10% per annum. And then on the other hand, the average return on the Malaysian government securities, which is actually a proxy to the risk-free rate class asset, is let's say 5%. Meaning if you would have put your money in any government bond like the MGS, right, you would have yielded 5% in terms of the coupon, all right, every year. So the trainer's measure will take your portfolio return, take away the risk-free rate and divide it by the beta. Now, of course, in this example, they compare between three fund managers, manager A, B, and C. Now, if you just look at the average annual return, right? Because most of us, when we talk about portfolio performance, we only look at the bottom line, isn't it? All right. But here it says, okay, manager A gave, had an average annual return of 10%, not too bad. Manager B was actually much better at 14%, but manager C is the best in terms of absolute average annual return at 15%. Okay, but on the other hand, the beta of their portfolio is very, very different. Now, for example, manager A's portfolio has a average beta of 0.9, manager B has a beta of 1.03, and manager C has a beta of 1.2. Now, remember what I said just now about the definition of beta. So what does this mean? Okay, now let's look at manager B first. Manager B, the beta is 1.03. It is the closest to beta equals to 1, right? So it means that the portfolio the management style of manager B's portfolio is very closely correlated to the market. And which is the market here? Which is the KLCI. So the movement or the performance of the portfolio managed by manager B is very closely tracking the KLCI. Now, on the other hand, manager C has the highest beta at 1.2, meaning what does it mean? It means that actually the portfolio will actually rise much faster than the market. For let's give you an example. When the market moves up 10%, manager's portfolio may move beyond that. Now, on the other hand, manager A has a beta of less than 0.9. So in terms of the correlation, it is not as closely related to the market as manager B and manager C. Okay, but if we take things into consideration, right? That putting all these formula putting all these parameters into the formula, we would have noticed that actually, in terms of the trainer's measure, manager B has the highest trainer value. Now, using trainer's measure as well as Sharpe ratio, the higher the number, the better or the safer is a portfolio. I will explain a little bit later after this, but let's just take a look using this formula, using this example. We can see that the market has a trainer value of 0.05, so that is as a reference. The trainer value of manager A is the lowest, very closely related to the market. And then manager B is 0.87 and manager C is 0.83. Now, if you were to talk about a risk-adjusted return among these portfolio managers, right? Although manager C has the highest average annual return, if you factor in the element of risk-adjusted return, manager B would have yielded a better performance. Now, when I say better portfolio performance, it does not necessarily mean the highest portfolio return, because obviously the highest portfolio return is 15% by manager C. But in order to achieve this 50%, you can see that manager C's style or his portfolio allocation has a much higher beta than manager B. So what does this mean? If the market is doing very well, like a bull market, like just like what we are going through recently, then manager C will perform very, very well. But on the other hand, if there's a market pullback, all right, then manager C's portfolio will suffer much more than manager B and much will be even more than manager A. Okay, so this is what it means. We want to look for a middle ground, means risk-adjusted return. But this risk-adjusted return is based on the beta, meaning it is based on what is the correlation of the portfolio against the or with the underlying market in this example, which is the KLCI. Now, on the other hand, instead of using beta, we can also use the standard deviation, and this is the essence of the Sharpe ratio. Now, it's basically the same thing. You see the numerator is the same. Average portfolio return, take away the risk-free rate. So using the same as before, in trainers measure the assumptions, right? But given that the 10-year KLCI standard deviation is 18%, all right? So we take these numbers and plug in the 18%, we will get the Sharpe ratio of the market against the these three managers. So now is manager X is 14%, manager Y annual return is 17%, and manager Z is 19%. Now, of course, if you look at just the absolute annual return, manager Z does appear to give you the best return of, right, because 19%. But in terms of risk-adjusted performance, is it the best? Right now, based on the Sharpe ratio, we can see that actually manager Z has the lowest Sharpe ratio among the three fund managers. You can see here manager X has the highest Sharpe ratio at 0.82. Manager Y has the highest at 0.6. Okay, now let me skip one to show you what is the meaning, right? Okay. The higher quality risk-adjusted return is obviously by manager X, despite having the lowest return. Now, because the Sharpe ratio evaluates the portfolio performance on the basis of both the rate of return, which is the annual return, as well as the diversification. Now, how does it take into the diversification element? Is actually by the standard deviation. Now, again, if you recall what I said earlier on, standard deviation means how far your data point actually diverges away from the mean, right? Now, of course, it's not just one data point. They took the entire data set. That's why they come up with a figure called the standard deviation. The higher the standard deviation, it means that actually the swing, it can be positive or negative, all right? It will be bigger. The divergence will be bigger compared to a smaller standard deviation. Now, this means that if your portfolio is not diversified very well, meaning say if you're like me, I tend to focus a lot on technology stocks. So, and you know, technology stocks sometimes the deviation can be the swing can be very wide, right? So my portfolio could have a much larger standard deviation. So if I measure my portfolio performance based on the Sharpe ratio, then my score will be definitely lower compared to a portfolio, say, which is more, invested into more passive stocks, which is not may not have such huge swings like the technology stocks. So that's what it means. Now, the theory is that if your portfolio is well diversified enough, the standard deviation should not be very large. It should, in fact, be smaller. Now, again, based on the Sharpe ratio formula, if your denominator is small, then your entire ratio will be high, right? So if the number on the bottom is small, then the entire figure here will be high. So that is why the Sharpe ratio really look at your diversification of your portfolio. All right. So again, just recap, the trainers measure measures the risk-adjusted return based on the beta of the portfolio. The Sharpe ratio measures it based on the standard deviation of the portfolio. Last but not least, the Jensen's alpha is a pure overperform, so pure performance, I would say KPI. So the formula is again very simple. It takes the portfolio return minus cap M. Now, what is cap M? Cap M is basically risk-free rate plus the beta of the market multiplied by the return of the market risk-free rate. Wow, such a mouthful, right? So what does it mean? Okay, now let's look at the assumptions here. Now, assume we have a market with a risk-free rate of 5%, just like our MGS. Then say a market return of 10% on the background. All right. Now these three managers here, D, E, and F, and they each have 11. They each clocked a 11% average annual return for D. Both E and F is clocking 15%. Right now, there's a dilemma now. So of course, based on the absolute return, I'm sure you won't choose manager D, right? Because manager D only clock about an average return of 11% per annum, whereas E and F is 15%. So if let's say you filter down to E and F, how do you, what other factors can you use to actually to decide whether you want manager E or F to manage your portfolio? Now, that is where beta again plays a role. As you can see here, manager E, the portfolio beta is 1.1, then the manager F is 1.2. Although very close, but they are different, all right? Which means that actually manager F, his beta is actually much higher, which means if the market moves up, his portfolio will actually move up faster, but if turns, you also come down faster compared to manager E, okay? Now, again, if you just plug in the formula here, this is actually already highlighted for you. You will see that the Jensen's alpha for E is 4.5 and the Jensen's alpha for F is 4.0%. So again, based on the Jensen's alpha, can see that manager E is has a much superior or better performance compared to F because its Jensen's alpha is 4.5. Now, logically, what does it mean? Now, just focus on these two. Let me zoom in for you, just for illustration, all right? Now, you have two managers, E and F, both are able to give you an expected return of 15% every year on the portfolio, all right? But in order to achieve this performance, manager F likely have to take higher risk because as indicated by its portfolio beta, a higher beta of 1.2 compared to manager E of 1.1. Now, ask yourself, knowing that both likely that they'll give you the same return, would you want to give your money for F, who may take how much higher risk compared to E to give you the same type of return? Of course, logically, as an investor, I would want to get the same kind of return, but applying less risk, isn't it? So that is the essence of the Jensen's alpha. The score will tell you that, if the annual return is equal, then the beta will tell us how much risk is factored in order to give us this kind of return. Okay, so wow, such a mouthful, isn't it? So in short, Jensen's alpha calculates the excess return on the portfolio over its expected return based on the CAPM model. All right, it measures how much of the return is attributable to the manager's ability to deliver above average returns adjusted for market risk. Of course, as I illustrated before, manager E did the best because his portfolio beta was lower than F. Okay, now, wow. Feels like going through university, right? Don't worry, there's a reason why actually these measures or these ratios or these figures are used. In a unit trust or in the fund management world, right? Actually, these are how fund managers are being evaluated in from his or her performance, not just based on the average annual return or the CAGR. Okay, so let's take a look at the pros and cons of these three measures. Okay, let's look at the pros first. Now, each of these three measures, they are actually quite good if you want to evaluate the risk-adjusted performance of different fund managers or different funds. Funds include unit trusts, mutual funds, or ETFs, so on and so forth. Okay, it is a very quick and dirty selection criteria for if you are shopping for a fund manager or a fund, right? And most of the database or database provider for these funds like Morningstar, they should have these either two of these ratios, like trainers measure and such ratios are very easily available, but Jensen's Alpha may not, because this is more unique. Okay, all right. But what are the cons? Wow. Now, as I mentioned, there are a lot of assumptions built into these three models, right? Now, what are the assumptions? Take a look at this. All right. First of all, you need to know what the market beta is. Again, how do you calculate beta? It's actually there's a science behind this, there's a lot of mathematical modeling for you to come up with the beta. Now, if you are like me, you are if you are a retail investor, right? How are you going to go through piles and piles of these Excel formulas as well as worksheets for you to come up with a beta? No way. The same thing for standard deviation, although I think the formula is much simpler. Okay, so these are all a lot of assumptions are actually being factored in order to come up with these beta, standard deviation, as well as so on and so on, right? So not only that, if you do not have the skills, then you may need to subscribe to certain software or tools. Could be very expensive in order for you to generate this kind of ratios. Okay, and last but and my personal take on this is it does not take into the allocation strategies of these different portfolios or these fund managers, because it's measured against your portfolio return only, and it doesn't care which sector or which industry that you are investing in. All right, and last but not least, my personal issue with using these three measures is that the flaw is not that the measures are flawed, but simply because risk and adjusted returns, in my opinion, are very, very personal traits. Now, my risk profile or my risk appetite could be very much different from yours. My expected returns for my investment can be also very different from yours. Now, don't get me wrong, risks is not necessarily proportionate to age. Doesn't mean that the older you are, the less risk taker you are. In fact, I have known a lot of older investors who are much bigger risk takers than I am. All right. So risk is not really a direct function of age. It is really about, your financial status, your assets that you hold right now, your commitments, which is very important. Now, expected returns, again, of course, everyone can say, I want as high as possible, but that's not realistic, isn't it? Expected returns should reflect, what you require or what you want out of your daily lives as well. So these two figures are very personal. That's why to generalize it over, these three measures, in my opinion, are not very practical, especially for retail investors like us, unless you are shopping for a fund or you're shopping for a fund manager. Okay, so what's our take? So how, instead of this using three measures, is there a much simpler way? All right, now this is how we do it. Now, our practical approach we do not use any of the three measures mentioned, although we may use the Jensen's Alpha to measure how much we outperform the market adjusted for risks. Okay, now our practical approach is very simple. You establish your personal objective first. How much you want out of your investment in terms of the absolute figure. So for example, how many percentage you want? 30%, 50%, 100%, 300%. Well, you've got to be realistic. And not only that, you need to define the period of time as well. It is meaningless if you say you want to double your investment 100%. It is meaningless because you may do it in 20 years time, or you may do it in 5 years or 3 years time. And it makes a huge world of difference, the number of years, Okay, I'll talk a little bit more about that later on. Then after you determine that, your objective, all right, or your target, then you got to determine as well, you got to be truthful to yourself. What is the maximum risk that I can expose my investment to? Now, there are several factors you need to consider. The first and foremost one, logically, is the drawdowns. Now, what is the meaning of drawdowns? Drawdowns refer to how much the portfolio or the value of your investment can drop from its recent peak, not from the beginning, not from initial capital, but from the recent peak. Right? For example, say your portfolio, you started with 100,000, then you go out to 150,000. Now, there's a market correction. The portfolio dropped to say 20%. So that is the drawdown, the maximum. So you have to determine already what kind of drawdown I can tolerate. Now, some people, they have a very high tolerance. They can make 100%, a few months ago, before this, then boom, 100% gone. They are still okay. They are very risk tolerant and they can tolerate very high drawdown. Some people can't, all right? So you got to be truthful to yourself. What kind of maximum drawdown I can withstand every year. And that will determine how much risk you need to take, okay? Now, of course, other factors that you need to consider are, what kind of sectors that you want to invest in, you want to expose to, because some sectors may be more volatile than the others, as well as currency risk, geographical risks, ESG risk, so on and so forth. So these are the things that you need to put into consideration when you want to determine your maximum risk exposure. Okay, now what happens after that? Now, when you have this information or these data on hand, then you need to actually set up your allocation plan. Now, this is not the first time I talk about allocation plan, and I mentioned before, I cannot stress enough the importance of this, right? You have to have a proper allocation plan. If you do not know what is allocation plan, please go back, please refer to LifeChamp's YouTube channel. Look for portfolio management topics under my name. I think there are at least one or two topics that I talk in detail about allocation plan. Now, after you have a plan, you have a good business plan for investment, what do? You need to execute it properly. You need to execute it effectively. There's no point for you to have a solid plan, but you don't execute it properly, all right? Okay, then along the way, you've got to review, you've got to assess your performance against your targets as well as against some other benchmarks. Only then, after your assessment or your review, then you can take further actions like rebalancing, restructuring a portfolio. If let's say it's really, in dire state, and worst case scenario, or you need to overhaul your portfolio. Say you really did not do a good job initially, all right? So because of your mistakes you did in the allocation or your execution, you may need to overhaul. But sometimes you may also achieve your target within the expected period, right? Or you have achieved your target as planned. Then you can reset your portfolio, meaning you can either roll your capital or you can take some, money, capital out from investments for gratification, then reinvest the rest, okay? And this process will repeat itself, and that is why the ones highlighted in green are involved in our engineering process of our portfolio performance, okay? Now, these first two steps is a one-off. You may need to redo it if there is a change in your lifestyle, like for example, you may have gotten married, you may have had a new child, or you may have other commitments that you did not plan initially. So you may need to redo your first two steps, then relook at these 1, 2, 3, 3 steps following. All right. So these are what I call the engineering steps that is involved in order to ring fence your portfolio returns. Okay. All right, so that's about it for the our practical performance measurement approach. Now, let's look at how can we benchmark our portfolio performance. Okay, this is a very interesting topic. Now, there are several options that you can use in the market. Normally, people will benchmark their portfolio performance against the market they are investing in. For example, if you're only invested in Malaysia, then it makes sense for you to benchmark your portfolio return against the KLCI return or the EMAS index or the Sharia index, which suits your need, right? Now, it doesn't make sense for you to benchmark your your portfolio in Malaysia against, say, Dow Jones Index or S&P 500, because number one, there are two different markets, and the construction of a portfolio, the allocation will be vastly different. All right. So it doesn't make sense. If you are invested, if your portfolio is purely in US stocks, then you may want to benchmark against DJIA, Dow Jones, S&P 500, NASDAQ, and so on and so forth. I think there are other indexes as well. Hong Kong, like Hong Kong Shanghai Index, Singapore STI. If you have a global portfolio, all right, of multiple markets, multiple currencies, then you may want to benchmark against global indices like MSCI, Morgan Stanley Composite Index, FTSE indices, so on and so forth. All right. Okay. The other option is looking into more detail rather than these general indexes, what we call sub-indices or ETFs. All right. So these are targeted benchmark against your major or your core invested sector based on your allocation. Based on your allocation strategy. I'll give you an example. You know that I do most of my stocks or most of my allocation are on technology stocks. I'll show you some examples later. So for my portfolios, instead of benchmarking against the KLCI, which I know KLCI is 30 stocks, mainly in finance, mainly in plantation, mainly in I think telcos, utilities, zero technology stocks, right? Which may change next year, but so far at the moment there's zero technology stocks. So it doesn't make sense for me to benchmark my portfolio against KLCI. It is more intuitive for me to benchmark my portfolio, which is more centric on technology, against say Bursa Technology Index. All right. So if you say your portfolio is more geared towards financial or banking or insurance stocks, then you may want to benchmark against Bursa Finance, healthcare, for your glove or your hospital stocks, so on and so forth. In other markets as well, in US especially, we normally use ETFs like the SOX Philadelphia Semiconductor Index to benchmark against portfolio that are leaning towards the technology or semiconductor sectors. Okay, so this is our our recommendation, how you can benchmark. Now, again, I think you will guess that actually we don't really use this. In fact, we benchmark most of the time, if not all the time, we benchmark our portfolio performance against our very own target. All right, because as I mentioned earlier on, we set objective how much we want to make over how long a time, right? So these objectives are very much based on our self-interest, okay? I don't really care what the KLCI do. I don't really care what the Dow Jones do, because the companies that invest in may be decoupled, or they may not be so strongly correlated to what the market is doing. So having your own target is actually more based on self-interest, and it is more practical in our opinion. Benchmark against your own target, and then you can use the absolute return with time. So don't just benchmark yourself with absolute return, especially if a portfolio has been going on for a few months to a few years, right? It makes sense for you to use CAGR. As I mentioned earlier on, to say that you have made 100%, you double a portfolio on the investment doesn't make much sense. If you say, it makes such a big difference. If you say, I doubled my investment in 1 year's time against I doubled my investment in 10 years' time, right? You see the difference now? So here we can use CAGR, compounding annual growth rate, to measure our return over time. Now, again, if you do not know what CAGR is, I recommend you to Google it, or you can actually refer to my earlier topics on portfolio management about the practical uses of CAGR. Okay, and then use a top-down approach focusing on quality. So instead of looking at the absolute return, look at how your allocation has delivered the performance that you want, or vice versa. Maybe you have or maybe you have highlighted a wrong sector to focus, or you may not have really, fully capitalized on your allocation when it comes to your portfolio industry exposure. Okay, now this option 3 is best suited for actively managed portfolios. Now, if you're the type who doesn't really like, or you do not have the luxury to track your portfolios like us often, right? So you will belong to the passive managed portfolios. Now, then in that case, all the measures or all the steps that I talk about may not necessarily apply to you. It'll be too much work. Okay, now our methodology here are more suitable for actively managed portfolios. Now, what do you mean by actively managed? Meaning, if you had done maybe more than a couple of trades a week or a month, right, it can be considered actively managed portfolios, because if you stretch it over a year, right, it can be quite sizable. Okay, then of course it is best suited for thematic-based or sector-based allocation strategies. And this option tree is essential for our engineering purposes when we want to rebalance or restructure our portfolio, especially when our portfolio runs into trouble. Now, by the sheer meaning of engineering, what does engineer means? Engineering means solving a problem, right? So of course you only apply engineering mitigation measures or steps if your portfolio runs into trouble, isn't it? If your portfolio is performing well, then please do not try anything out of the blue. Okay, just let it be. Okay, and just to wrap things up, actually our preference is option 3 plus option 2. As I mentioned earlier on, first we measure against our own interest. We measure against our target, how much we want to achieve over the specific period of time, how far we are from the target, or how are we overachieving the target. Then next, we also want to benchmark our portfolio return based on especially the ETF or the sub-indices that we are focusing on. As I mentioned earlier, at Spiral Thinker, our core is most of the time technology or semiconductor stocks. So we always benchmark ourselves, our portfolios against the Bursa technology performance. Okay, so it is a combination of option 3 and option 2 for our case. Okay, so I hope it's clear enough. Now let's visualize how do we, keep track or benchmark our portfolio return. Now, as an engineer, if you follow me, I really like to use charts. I like to use graph, okay, because it makes visually more easier to understand the situation as well as to highlight the problems at hand. Okay, now the first step in order for you to start benchmarking a portfolio is to have an objective, as I mentioned earlier on. Okay, say I want to grow my capital from 100,000 to 200,000, which is 100% over 5 years. Remember, tenure is very important, the period of years. So which translates to about 14 to 15% per annum compounding annual growth rate. And I assume this is close end, meaning I don't take money out for these 5 years, right? I just leave the money in the investment. So first you draw a chart, you split, okay, for today until 5 years later. All right, you split your time in terms of time. First year, second year, third year, fourth year, fifth year. So this is the time frame of the investment. All right. Now, it is very easily done if you have a very simple Excel skills. So far as I'm concerned, I do not know any tools out there that provide this kind of visualization. But trust me, it is very easy to do. Just Google or YouTube, how to draw charts in Excel, right? I'm sure you get a lot of answers there. Okay, now after you have this is in terms of because my target is double amounts of 100 to 200 here, then over 5 years, right? 1, 2, 3, 4, 5. Now next, what I'm going to do is I'm going to draw, imaginary lines, I will call them. Say, of course, if I can achieve my doubling in 5 years, less than 5 years, so my portfolio should be performing along this blue line. Okay. Now, if my target is to double in 7 years, so which translates to about 10%, so it should be green along the green line. If 6%, it should be along the red line. Now, sometimes it is also makes sense for us to have multiple lines here so that we know how far we are from our target or we have overachieved. Okay. Now, let me give you an example. This is from a real portfolio. Okay. As you can see here, the first year it was quite okay because it was just hovering along the 15% target. But something happened during the second year. Something happened, which I'll tell you the story behind this during the case study topic, right? So this is where we can see, oh my goodness, the portfolio has tanked, the performance has tanked, it has gone back to, in fact, below the initial capital in the second year, all right? And we know that this is how far we are from the intended target. So in short, we have to do something, or we have to review, as I mentioned here, we have to review our portfolio here already. So we either need to rebalance, restructure, or of course, if you ask me, if you want to overhaul after the first year, it can be a bit of overkill. So normally I would just either restructure or rebalance if I have if I've seen this kind of problem, okay? Now, of course, right now, this is the latest portfolio performance. It is above the 15% line. So it means that this portfolio has overachieved its target for now. For now. Doesn't mean that it will stay on here forever, it go up forever. It may come down again. So what can you do? So we leave this for the case studies later. So make sure that you stay until the end, yeah? Okay, now, again, as I mentioned, so this is measuring against your own target, right? For example, this is a doubling target over 5 years. So this is what it means by measuring against your own target. But how about measuring against the portfolio performance against benchmark? Okay, now this is for another portfolio, so I did not hear why, so that you guys don't get confused. This is from a portfolio X, sorry for the typo. This is portfolio X, okay? Now, and then this is another portfolio Y. Now, portfolio Y, this tenure is between, I think, April last year until the end of 2020. So it's about 8 months time. Okay, you can see the blue line is a portfolio return, and the green dotted lines is a KLCI performance, the KLCI index, right? Of course, you can see that this portfolio have done very well between April 2020 and 31st of December 2020, because it has overachieved, or it has overperformed against the KLCI. But if I were to tell you that this portfolio has actually invested the allocation is mostly concentrating on glove stocks. So then can we use another index to benchmark against the return other than the KLCI, right? Of course you can. Now this is where we can use the Bursa Healthcare Index, which I think was just recently incepted, not too long ago. Then you can see, wow, against the Bursa Healthcare Index, then it feels like, yeah, we should have done some more, right? Because the index has gone up more than 200% at the peak, whereas our portfolio only went up by about less than 50% in the 8 months window. Now, there's a reason for it. The reason is because you can see here, most in these 8 months, this portfolio was mostly in cash, denoted by the pink bar. So the blue bars, the dark light as well as blue bars are the glove stocks. I zoom in for you guys to see. So these are the Top Glove, the Harta, the Supermax, and the Corsans, right? So we invested in this. The orange ones are the non-glove stocks, non-healthcare stocks, which includes tech. And then the pink are the cash balance. As you can see here, the problem is we have underinvested during this period. Then at least, it is very good for you to review your past performance, so you know where you have, made a mistake. Now, if you ask us, although this portfolio did quite well in 2020, but we have severely underperformed against our underlying benchmark of the healthcare index. The reason is because, like we were so unsure in 2020 with the pandemic breaking out all over the world, with economies being locked down, right? We were also very unsure. We're also human. We also get scared. So we decided, to actually take less risk by putting more cash in case, you never know, the world may really come to an end, or there may be a further market deep corrections. All right, so this is what happened. Now imagine if we had not been so conservative and we had plowed more allocation into glove stocks, then this portfolio performance should have been much better. But of course, this is on hindsight. Everything is much clearer on hindsight, isn't it? The most important thing here is the lessons learned in this year, how you can avoid or how you can improve your portfolio allocation strategy moving forward. And that is what we actually did. All right, I'll show you later during the case studies topic. Okay, all right. Now, next we move on to the third topic, which is the importance of allocation strategies. Okay. Now, there's a couple of caveats here I want to talk about before I move on. Firstly, as I mentioned earlier on, these strategies are applicable for actively managed portfolio. So if you are the passive type of investors, right, it may not be your cup of tea, or in fact, it may be an overkill for your style. Okay. So this is only is more suitable for actively managed portfolios. It's less intuitive, again, as I mentioned, for passive style. And I want to highlight here that my personal COC, circle of competency, or the Spartinger's circle of competency, is on technology and semiconductor. And that is why you will see that actually a lot of allocations are leaning towards the technology industry. So don't ask me why, why I don't invest in plantation or why I don't invest in finance. Those are also good, a lot of investment opportunities, just that it is not within our expertise or within our skill set. So we prefer to stick on what we know. Okay. And again, just by coincidence, Malaysia, I'm not sure if you know, about more than 40% of our exports is actually from semiconductor. Okay. Now, just again, a recap. This is based from a slide earlier this year about our qualitative approach, to stock picks or to look at industry. We also use the same when it comes to portfolio allocation strategy. All right. Now, we always look top down first, meaning we look at the big picture. We look for what are the sectors or the themes or the thematics that are trending. For example, now what is trending? EV, right? Electric vehicle. That's why we are actually putting more work into this space. Then after we decide, or we come up with shortlisted, a number of sectors or one or two single sectors which we would like to focus on, then we look for the market leaders or the best in class among the players or among the participants in that market. Then sometime, there may be a case of a couple of examples where price and price and value diverge from each other. And this is especially more visible, or we observe more of these cases, especially when there is a huge market volatility. We normally find value emerging when market is crashing or in deep correction mode. And that's why we love this. Okay. Right. So this is our ultimate objective when it comes to the allocation. We look at top down. Where are the sectors or what are the themes we want to focus on? Then we look for the best in class of the market leaders. And if you cannot, if you can wait, you can wait for the price or value divergence, or you can start to slowly execute your allocation plan already. Okay. Now, during the sale phase of the portfolio, even before you even start buying in the market, right? You have got to set up what is your objective, your allocation strategy. And to do that, you have to ask yourself, what are your COCs? What are your circles of competency? Mine is technology. It may not necessarily be yours. I can sleep very well if my technology stocks came down 10% overnight, because I understand the industry, I understand the business, but you may not. All right. So I would advise, or I would recommend you guys, listeners, to really stick on your circle of competencies. Of course, over time, you can take up more skills, you can read out more, you can actually expand your number of COCs, right, to include other sectors other than your core. Okay. So for example, for us, our core is technology, but we do try to extend outward to look at aviation, to look at plantation. We will not look at finance because it's just too challenging. We can't really grasp it. We may look at insurance, or this is our attempt to expand our COCs. What are the emerging trends you see? As I mentioned just now, a few years ago we would say 5G, but 5G, the investment peak has actually passed. So now we're looking at what are the technologies which can be enabled through 5G, and one of them is actually EV, okay, electric vehicle. And then you ask yourself, is the information that you seek about the industry or the company or the markets you invest in easily available? Because it's meaningless if you want to invest in something that you cannot get hold of information about regarding that asset class or that market, right? Because you'll be blind if you do not have information to actually supplement your research. And it will be best, it will be ideal if you can have engagement with the management through AGMs or through emails. All right, are they transparent? Are they forthcoming with the plans? So you can get a lot of this information through the annual reports or the quarterly reports. Do you have home ground advantage? And this to us is very important. No point for us to invest in something which is across the big blue ocean, right? And we do not see what the business is about. I would rather invest my money, my hard-earned money, in something that I can see and something I can follow through. Now you may ask, Apple is is a US company, but you can see Apple products everywhere, and reports are easily available from multiple research houses, from multiple sources. Management is forthcoming. They actually, they have a podcast, they've got earnings calls, so on and so forth. And by the way, this is not a buy call for Apple shares, okay? I'm just using it as an example, okay? So these are the things you need to consider before you begin even your allocation strategy. Then your initial allocation phase, as I mentioned normally we do bottom-out selection after we select the theme, right? So from sectors to stocks, we pick the stocks based on that, which I think this is just a repeat of what I said again. We prefer market leaders or the best in class. Then last but not least, you need to allocate, or you should allocate based on your risk profile. Don't look at your neighbor, don't look at your friend. Your friend may have a totally different risk profile, risk appetite compared to yours. So just allocate based on your risk appetite as well as your investment target. Okay, so as I mentioned, allocation, plan for it, execute your plan, review your execution, and this process will repeat itself. And this is why we call it the engineering cycle. Okay. So this is an example of initial allocation setup, and I presented this back in 2019 in November in a portfolio timing topic. So this is based on real portfolio. Again, this is based on portfolio X. Just to recap, portfolio X. This is portfolio X performance today. So the initial allocation I showed just now is actually happening here back in 2019. Okay. But of course, this portfolio started in 2019, January 15. Okay, so coming back to here. So this was the initial allocation. Wow. By the way, just want to highlight, this is 2019, January. Of course, on hindsight, if I had known COVID is going to happen in 2020, I would not have put AAShares or Tune Pro here, right? But because by that time in January 2019, we believe that the passenger aviation sector was on a high growth trajectory and the business should easily double within 3 years. That's why we decided to allocate 40%, 25 plus 15 of the initial allocation to AAShares and Tune Pro related companies, related industry. Okay. We also believe that the smartphone trends are moving towards more powerful camera modules, augmented reality, as well as higher smartwatch sales. That's why we also allocated about 30% in these technologies, semiconductor stock, electronic, and soft. Okay, so if you want to have more details in this, I do recommend you to go back to search for this video in LifeChamp's YouTube channel. Okay, so this was the initial allocation plan back then. We done research, top down, bottom up, selection. This is what we came up with. Now, do we stick to this? Stick to this no matter what happens? Definitely not. We have to see what the market, how the market evolves over time. Now, more often than not, you have to accept the fact or the possibility that we may get our research wrong. We may get our allocation wrong. We may get our industry focus wrong. Yes, just accept the fact that at least when you do see that, it is easier for you to act. Don't try not to put your feelings or try not to involve your ego in this process, because it is going to be quite detrimental to your portfolio performance. Okay. Now, so in short, this portfolio has evolved along the months. Back in 2020, this year in week 22, The technology exposure was 41%. So I won't show what are the stocks that this portfolio does. SC is very hardworking these days. They don't want us to appear to be recommending any stocks, right? So in this portfolio back in week 22 this year, it has about 28% cash and 72% equity. So the equities portion is 41% invested in tech. Remember, our focus is always on tech. All right, that's why we are most of the time our allocation will be concentrating on the technology sectors. Okay, then of course we're a little bit in petrochemicals, then steel, oil and gas, and others. Then a few weeks later, about 4 weeks later, you can see what happened, because we see because I think there was a time when a lot of tech companies in Malaysia, they started reporting very good results. So we decided to take push more allocations from the other non-tech to more tech. So by then, our tech exposure was close to 60%. We also allocated some capital into transportation and shipping. We reduced our steel exposure. We reduced our oil and gas, so on and so forth. You can see how this evolved, right? Okay, so 58 from 41 tech to 51.8% tech. Then fast forward to week 39, again on the same portfolio, right? This portfolio, because it has overachieved it has done very well. So we decided to, sell our profits into strength. All right. So instead of 75% equities here, we sell down to 60% equities and 40% cash. This is how we manage as well, right? But of these 60% equities, right, which is still invested in the market, we are 76% focusing on technology stocks that time. Okay. So of course, we reduce the number of these sectors. We actually have a lot about close to 3/4 of our capital invested in technology stocks. Fast forward again to, I think last week, week 42 was last week. We decided to plow more. We decided to buy back the stocks that we sold. So now the equities pushed to 70%. The cash came from 40, came down to 30%. But we have reduced our technology significantly because the technology stock had went up too fast as well as too much. So we think that we thought that it is high time for us to take more profits. And what do? We actually push our allocation. We distribute allocation to other thematics, to other sectors like the recovery theme, inflation theme. These days, if you are following the American markets or the macro news, the macro development in US as well as other developed nations, you can see the inflation is becoming more and more possible. That the narrative on inflation is getting louder. Okay, we also put some in logistics and others. So we can see how we massage or how we evolve, how our allocation plan, sector allocation plan evolve over time based on the market movement. Yeah. Okay. So last but not least, let's take a look at some real case studies. I'm a little bit behind time, so I hope bear with me. Okay, so this is again a third portfolio Z. This portfolio was started in 2018. June. And this is based on the latest, I think, performance back in week 42. Now, again, just like any other portfolios, this is a technology-centric portfolio. So we split these to 3 phases. Yeah. Now, unfortunately, because this is a tech-centric portfolios, something happened in 2018 under Trump's administration. The US-China trade war happened, and the relation between US and China deteriorated, right? Under President Trump's administration and directions. So technology stocks took a bad beating. But in fact, the whole market was actually bad. So the beta of the market was actually down. So naturally, portfolio also, most of our portfolios underperformed in that period. If you've done very well in 2018 or 2019, congratulations. You have done a much better job than I did back then. Okay. Then in 2020, as you know, COVID happened. We did not immediately invest in glove stocks. We only started buying seriously golf companies sometime by the end of towards in the beginning of April. As that's why you can see the inflection point here. Okay, so we decided to plow allocations on the glove stock while having more than 50% cash, too conservative. And again, as I mentioned earlier on, we learned the lessons here because we're too conservative. So in 2021, because of the work from home culture that boosted the demand for consumer electronics, as well as, you know, the explosion of the shortage economy. Everything is in shortage right now, right? From the trucks to ships to cargos to your semiconductor chips to your workforce, right? So we are truly in the living in a shortage economy. So we decided to refocus back on technology, and that's why we that is the reason, one of the reasons why it gave us the alpha performance here. Now, our learning lessons is, again, as I mentioned here, we have in the first phase, we over allocated, over trade, as well as we were investing in a January pool market background. This why our portfolio performance was unsatisfactory. Then in 2020, during the pandemic era, we focused on glove, but we were too conservative on cash. So we learned our lesson. In 2021, we optimized our cash deployment. We don't keep too much cash, but we focus on quality technology stocks that benefit from this work from home culture, as well as, you know, the US-China trade war, US for US, China for China policies. We look for companies, top quality or best-in-class market leaders that benefit in this, and that's why we can overachieve this in 2021. But a big but. If you look at the overall performance, remember, you have to benchmark against yourself, right? Look at this blue line. Now, this blue line, although I did not label it, it is a 15% per annum blue line. It is the blue line. It is the portfolio value which should achieve. The portfolio should achieve if it is in line with the doubling every 5 years. So we still have actually a lot to do for this portfolio, meaning we are still underperforming our own target of doubling this, I think about 300,000 to 600,000 in 5 years' time. So, okay, so I give you a very practical example here. I'm sure some of you listening tonight may be going through this exactly like this portfolio, right? So there are things that you can do later, which I'll show you later in the next case study, what we are doing after this in order for us to continue hitting our alpha. Okay, so this will be the last case study for tonight. Again, we are going back to portfolio X. I think just to recap, this year 1, 2, 3, 4, 5. Right now is doing very well. So the initial year, right, the first year, I would caution that please do not over-engineer, especially in the first few months. It doesn't really make sense for you to do too much because, again, if you do it well, you would not have deployed most of your allocation in the first few months or even the first year. All right, if you don't know what I'm talking about, please again go back, look for the portfolio management topics or portfolio timing topics in LifeChamp's YouTube channel. All right, try to give time for the portfolio or the market to mature, to cycle. I would say to cycle, just like prime pumping your well. This, to me, I call this cycling a portfolio as well. Okay, you need to give your portfolio time. You need to give your initial allocation plan time to show you whether it is working or not. If it's not working, you've got to rebalance, you've got to restructure. But before you give it enough time, right, try not to overdo, try not to change too many things, all right, especially for the first year. Then on the second year, as I mentioned, COVID outbreak. So for this portfolio, just like the previous one, we were too conservative on cash. For this particular portfolio, our cash was as high as 70% at one point in time, but we switched our strategy to focus to quality glove stock as high as 40%. Of course, on hindsight, if you ask me, I wish that I had deployed more into glove stocks then, all right? But, you know, that is on hindsight lah. Okay, then in 2021, this portfolio has overachieved our target of doubling in 5 years' time. So what we did was we decided to take risks by, what do we mean by taking less risk? The objective is to minimize the drawdown. Now the drawdown means from this point, we want to minimize the impact on the portfolio should the market crash or the market goes through a serious deep correction. We don't know, it may happen, it may not, but we don't know. But since we have overachieved our target for now, so we decided to minimize the possible drawdown effect, all right, by reducing exposure on growth stocks, meaning we sell into profits, some of the high growth stocks, especially technology stocks. We decided to increase our allocation into high yielding stocks that gives good dividends, that have high earnings yield. We also decided to increase our cash holdings at this point. So again, if I simplify, right, I visualize our strategy. It's very simple, as you can see here. So this is our 15% per annum line, right? As long as the portfolio dips down below this line, then we will be deploying more cash to buy quality stock or stock that are beaten down, stock that have a very good price to value. Quality stocks that has a very good price to value divergence. Same thing here as well. We did exactly the same. And when the portfolio performance is above this line, we normally would take less risks. All right, and the effect of that, is actually the portfolio is actually on the long term is growing. You can see lower low, higher high, as they call it, right, in technology and in technical analysis terms, right? Of course, this is all past performance already. Can we sit on our laurels? Can we just relax here? Well, we can relax in the sense that we can take less risk, but don't forget, this is a 5-year plan. We have 2 more years to go. We have 2 more years in order to achieve our doubling target of 200,000 from 100,000. So moving forward, we will be restructuring and rebalancing our allocation to focus more on, in the short term, we will be focusing on quality recovery companies, as well as inflationary, good companies that are involved maybe in the commodity supply chain, like agriculture, like, raw materials. For the long term, we'll be focusing on EV theme. We'll also be focusing on the automation, the industry revolution 4.0. Okay, so that's what we're gonna do. We never rest until we reach our target. Okay, now, so last but not least, what is our timeless principle? If I am able to simplify into a picture or a few words for you. Now, this is actually very simply how we optimize our portfolio allocation by capitalizing the market uptrend or upcycle. How do we do that? We optimize, we actually deploy most of our allocations in favor of the trending thematics. All right. Right now, we believe, you don't have to take my word for it. We believe EV is the next big theme, and it may not just last for a few months. It may last for years. So this is where we are banking our buck on this, right? So we hope we are allocating more capital into this theme. Hopefully we catch the beta much more than one. Now, if there's a market correction, right? So we would like to minimize our drawdown impact during cycle turns by either diversifying to other sectors, or by cash management, for example, raising more cash. And how we do this, I think just to recap very quickly, I show here, right? So this is actually, in terms of actions, is what we do. So you can see here, our technology exposure has been reduced significantly from here to here, all right, 76% to 43%. Then we also diversify into other themes, as well as raising our cash balance from from before to higher than this. I think it will be higher this week as well. Okay. Then last but not least, before I hand it over back to Shane, I just want to, because this is my last session for this year, so perhaps just to, just be a bit more relaxed, borrow the words of Mr. Albert Einstein. So know your limits first. You've got to establish where is your limit. Now, once we accept that, right, then we go beyond them. Okay. So with that, I hope that you've enjoyed my session tonight. It could be a bit technical, especially at the beginning when I talk about the three measures or the three ratios. But I'm sure that if you guys can get the gist of it, you know how to apply it, right? I'm sure you are on the right track in engineering a portfolio performance over the long term. Okay, Shane, Chun Sian, over to you.
Thank you so much, David, for doing this advanced portfolio management topic. So if you have any question, you may write in the Q&A box. Yeah, so we have about 15 minutes or 10 minutes for Q&A. All right.
I think we can actually allocate a couple more minutes tonight, right?
Okay.
Since this is my last topic for this year.
Sure, no problem. So the question here is, could you give us some example of inflation stocks?
Okay lah. Without how to say, committing any crimes, drawing the line. Yeah. Some of the, I would say,
maybe you talk about the sector lah, or
yes,
the industry.
yes.
Yeah,
no. For us, we look at raw materials, so it could include agriculture products. It could also include energy stocks, because as you know, that actually a lot of this what characterizes inflation? It is actually the increase in prices of the commodities or goods that we use. So in commodities, actually one of the products or one of the assets, the commodities that actually make up bulk of the commodity index, right, is actually energy. When I say energy, I'm talking about oil and gas. So naturally, in our portfolios, we actually have a bit of oil and gas stocks lately. Although on long term, in terms of the ESG, we feel that oil and gas is a sunset industry, but because of this short-term thematic play, we actually invested a little bit on some oil and gas stocks. I would say some industrial products, industrial raw materials like steel, food related to sugar or milk, so on and so forth. These are all inflationary, I would say, sectors.
Okay, thank you so much for giving us the idea. I think that addressed the two questions asked by Chua and also Chun Wai. Okay. So yes, I would like to ask, how many stocks should you have in your portfolio to diversify? Why don't you consider Hong Kong and US market as well?
Yeah, I do invest in Singapore. Hong Kong, I'm studying. I'm not too comfortable yet because the market dynamics and I would say the culture is very different. But or at least in Spiral Thinker, we do keep track of a lot of Hong Kong or Chinese companies that are listed in Hong Kong, all right, to be more detailed. But coming back to your first question, how much should we diversify, right? It really depends on the size of your portfolio. Now, if you are having, say, 100,000 portfolio compared to 1 million or 10 million ringgit portfolio or USD, right? We never know. It is a very different dynamic. So your diversification strategy will be very much different. Now, again, I'm recapping from my previous sessions with you, Chun Sian, from previous webinars. For 100,000 portfolios, I would say try not to over diversify. Anything more than 5 or between 5 and 10, I would say it would be ideal. For 1 million, I would say anything less than 15, and beyond that, personally, I would not go more than 20 stocks in one single portfolio. But of course, you can have multiple portfolios serving multiple markets. So it's easier for you to manage. You split it out by bite size. Yeah. So I hope I answered his question.
Just now you say for portfolio up to 1 million, less than 15, right?
Yeah, 15, 15, not 50.
Okay.
I mean, ask yourself practically.
Sounds like 50.
How many companies can you track in a year? How many reports can you read? How many AGMs can you attend? Yeah. So again, I am full-time investor. I can't follow effectively more than 15 companies at a time, or I can stretch it max 20, but that's about it. Maybe I'm older already lah. My brain power is not as good as a 20-year-old. Yeah.
But we still need to follow with all the company in the watch
Yes,
list.
definitely.
Still
Yeah.
in the watch list, haven't count into that.
Yeah. I mean, you multiply that by 4 quarter reports and one annual report, as well as multiple, sales side reports. There are tons to read.
Okay. Okay, hang on. Okay. Should we invest and hold eternally like Warren Buffett to save brokerage fee, like such as Nestle and Public Bank 50 years ago? This is asked by Kun Lee.
Kun
Lee.
Oh, Kun Lee. Okay, I'm gonna dissect your question because I don't want the participants to misunderstand my answer. All right. You say, is it okay? Should we hold indefinitely stocks like Warren Buffett, right? And what else did you say? There's a very important word.
To save brokerage fee.
Okay, to save brokerage fee. Thank you very much for that. Now, if that is your objective to save brokerage fee, please don't do it. Don't lose the forest for the trees. Brokerage fees, don't try not to put too much weightage on brokerage fee. It is a cost of doing business, in my opinion, right? In fact, the brokerage fees are so cheap these days. But again, don't take me wrong. It is not a license for us to overtrade as well, okay? So that's definitely not it. We trade because sometimes we want to reduce our exposure. We want to take profits. We want to increase our allocation, or we want to diversify. Yes, those are reasons for trade. But to save brokerage fees or to overtrade, that's not it. And I would like to correct as well. Warren Buffett does not hold perpetually all his investments. It really depends on the categories of the companies that you invest in. Again, there's another topic by myself with Chun Xian, where I talk in detail about the categorization of your companies, and that is a very important role. Let me give you an example. Oil and gas stocks, are you going to hold indefinitely? Regardless whether it has the most solid management, it has the best business model in the world, are you going to hold oil and gas stocks indefinitely? Definitely not, because it is in a cyclical industry. Personally, I have Nestle in my portfolio, and I'm being very open about it. My Nestle's are for my children. My Nestle's shares are for my own retirement. It's for my grandchildren. Next time, right, when I die and leave this world, right, I'm not gonna leave properties for my children, right? I'm gonna leave stocks. I hope that I will have enough Nestle scripts to give, yeah. And for those kind of companies, right, likely that I will hold until I die lah. I will not say indefinitely, but maybe until I die, or unless there is a fundamental shift in the business. For example, if you tell me Nestle tomorrow or suddenly were to switch business model to become property developer, then I would really reconsider my holding period. Or if something is fundamentally wrong with its core products, like somebody really proved that there's a eating Maggi mee or drinking Milo will cause cancer, yes, I would change my investment strategy. But safe from that happening, right? I would be holding companies like Nestle in a much longer and stretch holding period compared to other sectors like cyclical, even technology companies. Although I always say that I'm evergreen on technology stocks, but technology, it changes so fast. Let me just give you an example. So that everyone can benefit as well. Apple is changing its business model recently. In fact, for the last few years already. So they used to outsource a lot of their, modules or parts to, OEMs or IDMs, we call it, right? Because they don't want to produce those parts, because they don't want to spend the money to build the capacity and the plants. But things are changing now, because give you an example, they are making their own glass now. They're making their own screens. I think based on their last announcement of the Mac, they are actually using more and more of their own chips, the M1 chips. So which means they are ditching Intel. They may be also doing a lot of other stuff on their own in the future. So companies that rely on the Apple supply chain, that relies on Apple as their main customer, right? Without a good diversification strategy, right? I think they'll be in big trouble. So although I'm saying I'm evergreen on technology, but we do look at what sub industry or sub sectors they serve, and who are their clients, and what is their their product stickiness. Yeah. So please don't, in a nutshell, please don't base your trading action on the trading cost. That's one. And secondly, study your stock categories properly. Yeah, before you decide.
Okay. This is an interesting question. How should we manage and assess the portfolio performance if we pump in monthly for investment?
Okay, good. Great question.
Close-ended fund.
Great question. I like this question. So maybe let me just go back to this one's chart, empty chart. So now, what you can do in this case, may I know who asked the question, Chun Sen?
The name is called Nike.
Nike, okay, Nike, thanks for the question. Yeah. So normally, again, I had here close end for 5 years, right? Now, if you plan to inject, save money, inject capital through savings into your portfolio, right? Congratulations, that's a great move, but please don't save 100% into your investment account, okay? Say you decide, all right, you can reset it every year. Now, for example, if the next year, so I decided to put extra 1K a month. So in a year, there'll be 12K, right? So what you can do is you can assume that the 12K will be inside your portfolio in terms of the accounting, right? In the beginning of the year. Although you may not have the cash, because your cash will come, so there is cash flow already, right? But of course, you may not necessarily use out your cash balance right away, right? But if you're the type who likes to use out all the cash balance incidentally, right, then this may not be a good strategy. So for me, you can either reset your portfolio every year or every quarter, decide depending on you. So it works the same if you want to withdraw money as well. So that will not be a closed end, that will be open ended, but I don't recommend that. I recommend that actually, if you can, right, save more. In your savings, right, you can actually allocate some into your investment portfolio. So you can reset it every year, or every 3 months, or every half a year, depending on your resources and your style. Okay, I hope I answered Nike's question. This is a very good practical question, and by the way.
Yeah, I think a lot of people also regularly top up in their stock account.
There is another measure called internal rate of return, IRR. I think there's a portfolio function in i3 Investor that actually has this. You can use that as well. So you just, the app will calculate your internal rate of return based on your cash flow.
Okay. Now, in regards to the question that, how much should we have in our stock for the size of capital, Chua has a question that, for newbie who has only 5,000, how would you advise?
5,000, there will be a few factors for you to consider, not just the number of stocks. The price of the stock, you have to be very careful as well. Let me give you an example. With 5,000, you won't be able to buy Nestle stock, that's for sure, because one Nestle stock is about $130 ringgit today. You won't be able to buy a company like MPI, which costs about 46 ringgit today, or you won't be able to buy Genentech at 45. You may need to look for companies with a stock price less than $1 in order for you to maximize or optimize your allocation, right? So with 5,000, for me personally, I would not go more than 2 stocks personally. All right. So now, what is the meaning of having 2 stocks? It means that you would have need to do much more homework than a portfolio with 10 stocks. Because with 10 stocks, you can afford to make a little bit of mistakes with 1 or 2 stocks, right? But with 2 stocks or 1 stock or 3 stocks in the portfolio, you make one mistake, that's a huge there can be a huge toll on your portfolio bottom line. So with 5,000 personally, I will go for 2 stocks, maybe 3 maximum. I will go for stocks less than 1 ringgit. Doesn't mean that I'll go for penny stocks. All right, I will still go for quality stocks. Don't get me wrong, there are still a lot of good quality stocks out there with high growth, even in technology space. I do have stocks that are few cents, sorry, not few cents, 几毛钱, 60, 70, 80 cents, all right? But try not to over diversify. With 5K, I would recommend you to follow Nike's method. You can start with 5K, then every month you put 200, 300, no matter how big, how small, doesn't matter. It is the discipline that is that is crucial here. Then over time, you will see your initial capital grow, and by that time, it will be easier for you to allocate. All right?
Okay. So Jonathan asked the question, for the return plotted in the chart, do we use the year-end value compared to the beginning of the year value to obtain the yearly return?
Okay. For this type of portfolio, right, sure, right, because it's closed end, all right, normally because I don't use absolute return anymore, I use KGAR. So here, just for your information, the KGAR is about, I think, about 20% per annum at this rate here. Excuse me. Okay. So I do not take year to date, so in order for me to assess the yearly performance, I actually look at the maximum drawdown for that year. Now, in this case, for 2021, the maximum drawdown happened here. All right, which is much less than the maximum drawdown here. Here, I think the maximum drawdown was about 18% in 2020 due to the COVID. Here, I think the maximum drawdown was slightly less than 10%. So in terms of the drawdown performance, actually, we perform much better here already. Okay, so you can do year to date. So if you want to measure year to date, you will be using this as your higher watermark. Year to date will be using here compared to here. Here to for 2021, whichever is the ending here, I will compare year to date from here. But I will for us, because it is a long-term closed-end portfolio, we will always calculate based on the beginning here, and we don't use absolute return. We use compounding annual growth rate.
Okay.
Is it clear? Is it clear?
Yeah. The next question is, how do you rebalance away from loss-making sector like gloves? Do you hold based on recurring dividends until the next recovery? Or exiting now means realizing losses?
Well, let me give you an example. Can I give an example, Shane?
Sure.
I know someone who invested 1 million ringgit in gloves. Today, his gloves, his portfolio, which is solid in gloves, right, is worth 200,000. So there is a drawdown or a loss of 800,000, right, 80%. Now my question is this: do I wait for the gloves to go back to its heydays, including the dividends given, right? All right. And if that happens, if that can happen, right, ask yourself, how long do I need to wait? Now, even before that, ask yourself, what needs to happen for glove companies in Malaysia to go back to, the pandemic high? You have to look at ASP, you have to look at the market, you have to look at the, the demand. All right. So if I'm not saying that gloves is already sunset, I don't know enough, but I do know that it is very hard for it to go back to its peak days in the 2020. And I know for a fact, or personally, I'm more confident that I can turn that 200,000 with a much better profitability prospects if I were to invest in other sectors. Don't get me wrong. I'm not saying that gloves is going to be a dying industry. Definitely not. Gloves is still very much in high demand. But whether the valuation of the glove companies, whether the market will give it that type of valuation like what happened in 2020, that, in my personal opinion, will be very challenging. That's why I would rather realize, like you mentioned, I've already realized the losses, I cut it, All right. Then I will look for other sectors which can give me better profits. Give me better prospects, give me better earnings visibility, that can enjoy a much bigger total addressable market to grow. So that is what I'll be doing lah. Yeah. Dividends in this sense, strictly speaking, to me, it's just a consolation prize. Yeah.
Okay.
Okay, I hope you're not offended. I know by saying this, I may have poured a lot of stock in a lot of glove investors. Yeah, but of course, if you're okay to hold for 10 years, right? I'm sure in that period, right, the demand for gloves or the valuation is going to catch up again. That one, I'm sure.
Okay.
Thank you.
The next question is, how sensitive should we review periodically for the allocations to the portfolio?
Well, it depends. For me, I do it at least once a quarter because I'm a full-time investor. There's no point doing every week as well, because you'll be running like headless chicken. At least do it once a year. At least I would say at least do it once a year, or if you can, twice a year or every quarter lah. Yeah, it really depends on your vocation, of what are the resources you have, how free you are. I'm sure that I'm sure a lot of us here are actually having your own careers, family to take care of, right? You may not be able to allocate so much time. So also try to allocate or structure your portfolio based on how often you can review it. If you are the type that cannot review your portfolio like even once a month or once a quarter, right? I would not try to steer away from very volatile stocks, because you may get a shock lah. You may maybe go for more passive or more less volatile stocks. But if you're the type who loves Excel like me, who personally I review the allocation every month, because every month I'll be reviewing all the portfolios that I have, writing reports on it, so on and so forth. So I do it every month. But again, it depends on your resources and availability. So at least once a year, at least.
Okay. Let's do one last question.
Yeah, sure.
Just now you mentioned about EV is going to be your, theme, for the next few years. So the question here is, what is your opinion on hydrogen cars, compared to EV?
Well, I'm sure hydrogen cars will find its market in one of the countries. I'm sure of it. In fact, I think some car makers are also pushing for the hydrogen agenda. Now, as with any types of emerging technology, right, there's always more than one contender, sometimes more than 2 or 3. So I won't call it EV, but this is what we call the new energy vehicle, right? So there are 2 camps right now. One is the battery powered camp, and one is the hydrogen powered camp. All right. So in my personal opinion, I will be putting my money on the battery operated cars rather than the hydrogen. But doesn't mean that there will be no hydrogen cars out there. I'm sure there will be in some markets, some countries, that maybe the hydrogen cars may have more in terms of quantity and infrastructure compared to the battery operated. Sorry, the BEVs, the battery electric vehicles. Yeah. If you want to know more, please follow our Facebook, because we will be announcing our very, very state-of-the-art, in-depth workshop on pure EV. So we're not just talking about the batteries, we're talking about policies, the algorithms, the architecture, as well as the market, addressable markets for EVs in the future. Yeah. Thank you, Shane. Thank you very much.
All right. Thank you so much, David, for doing this advanced portfolio topic for us, which is engineer your portfolio performance by allocations optimization. All right. I think today we have learned a lot, very advanced strategies on how we can manage our own portfolio and how we can adjust it along a different thematic play. And I think through the case studies, we learned from David a great deal.
Yeah. So again, all the best to you guys, and do take care for the rest of the year. Yeah.
Okay. I think, David, there are also some questions you might want to reply privately in
Okay. All right.
Q&A box. So while I tell them about the next webinar. So thank you so much, everybody, for tuning in. So just give me a minute.